New York City, October 1907. For a week now, the lines outside the banks have been growing, and tonight, in a brownstone library on Madison Avenue, the most powerful private citizen in America has locked the door on the country's leading bankers, literally locked it, pocketing the key, and told them, in effect, no one leaves until you have pledged enough of your own money to stop the United States from failing. The man with the key is 70 years old, with a nose ruined by disease and eyes that one photographer compared to the headlights of an oncoming train. His name is J.P. Morgan. There is no Federal Reserve, no deposit insurance, no bailout fund. In 1907, the lender of last resort for the American economy is him, personally, or it is no one. And the reason the nation is on fire tonight traces back absurdly to two speculators and a scheme, a plan to corner the stock of a copper company. It failed in 15 minutes. The men who tried it lost millions, and their failure lit a fuse that burned through every bank and trust company those men had ever touched, then through their neighbors, then through a nation that suddenly, all at once, wanted its money back. No con man this week. Something scarier, an honest panic. This is the story of 3 weeks in 1907, the crash that showed America exactly how its money worked and frightened it into building the Federal Reserve. Begin in Montana. Fritz Augustus Heinze is one of the great buccaneers of the Copper Age, a brilliant, charming engineer-lawyer who made a fortune in Butte by outdigging and outsuing the giant amalgamated copper. By 1907, he has sold out for a legend's price, moved to New York, and, fatally, decided that mining money entitles him to be a banker. He falls in with Charles W. Morse, a financier already famous for rigging the ice trade. In an age before refrigeration, Morse cornered New York's ice supply and squeezed the city until the newspapers howled. Ice, shipping, banks. Morse collects control of institutions the way other men collect watches, using each bank's deposits to buy the next. Together, Heinze, Morse, and their circle sit on the boards of a chain of banks and trust companies across New York. Depositors' money, wired together by ambition. Remember this wiring. It's about to matter enormously. October 1907. Heinze and his brother convince themselves that short sellers have borrowed more shares of their family company, United Copper, than actually exist. If true, the Heinzes can corner the stock, buy everything, then force the shorts to buy back at any price they name. It is the oldest power play on Wall Street. On October 14th, they strike, buying aggressively on the curb market. United Copper rockets from under $40 to $60 in a day. The corner looks glorious for exactly one more day, until the shorts, it turns out, can find plenty of shares. The Heinzes' math was wrong. On October 16th, United Copper collapses from 60 to 10. The brothers are ruined before lunch. In a healthy system, two speculators going broke is a Tuesday. But every depositor in New York knows the wiring. Heinze isn't just a speculator, he's the president of a bank, the Mercantile National. By morning, a line stretches from its door. The bank is likely sound, it doesn't matter. Depositors don't audit. They remember, and they remember Heinze. The clearinghouse forces Heinze and Morse out of all their banks in exchange for support. Too late. The question every New Yorker is now asking is the one that kills fractional banking. Who else is connected to these men? The answer, rumor decides, is Charles Barney, president of the Knickerbocker Trust Company, third largest trust in New York. Marble and bronze on Fifth Avenue, 60,000 depositors. Barney knew Morse. That association is enough. Understand what a trust company is in 1907, because it is the shadow bank of its day. It takes deposits like a bank, but sits outside the clearinghouse system, keeps thinner cash reserves, and invests in racier assets. Higher returns in good times. No lifeboats in bad. On October 22nd, the Knickerbocker's depositors come for their money. In under 3 hours, the trust pays out $8 million in cash across its marble counters, then stops mid-line and closes its doors. 60,000 accounts frozen. Barney, denied help and disgraced, will be dead by his own hand within weeks, and his depositors' panic becomes every trust depositor's panic. The fire has jumped the firebreak. Now it's a national crisis. The Trust Company of America besieged next, then others. The stock market seizing for lack of loans. Interest on overnight money touching 100%. And out in the country, banks that keep their reserves in New York banks begin pulling cash home, draining the system from the inside. There is no central bank. There is no mechanism. There is only one address left in America: 219 Madison Avenue, the private library of J. Pierpont Morgan. Renaissance manuscripts, a study lined in crimson silk, becomes for 3 weeks the de facto central bank of the United States, run by an old man with a cold playing solitaire between meetings while the American financial system waits in the next room. Morgan triages like a battlefield surgeon. The Knickerbocker he lets die. His men glance at its books and pronounce it hopeless, a verdict historians still argue about. But the Trust Company of America, examined overnight, is declared worth saving, and Morgan announces the decision in a sentence that becomes the panic's turning point. This, then, is the place to stop the trouble. Money is summoned like weather. The U.S. Treasury deposits $25 million into New York banks. The government, note carefully, deposits it effectively at Morgan's disposal. John D. Rockefeller pledges $10 million and tells the press he'd give half of all he has to keep America solvent. When the stock exchange president crosses the street to say he'll have to close the market, Morgan raises $25 million from the banks in under half an hour to keep it open. He even recruits the clergy, bankers, brief ministers on Saturday so that Sunday's sermons preach calm. It is central banking conducted as theater, seance, and protection racket at once. And it is all improvised. The climax comes the night of November 2nd. A major brokerage will fail by Monday unless the trust companies, themselves bleeding, pool money to save it. The trust presidents refuse. So Morgan invites them to the library, waits until the arguing exhausts itself, and locks the door. The key goes into his pocket. Around 4:45 in the morning, he lays the pledge paper in front of the leader of the holdouts, puts a pen in his hand and says, "There's the place, and here's the pen." They sign. The panic measured from that dawn is over. 3 weeks of chaos leave a strange ledger. The system survives. The depression that follows is sharp but short. Morgan is celebrated as a national hero, and almost immediately, a scarier thought replaces the gratitude spoken across the political spectrum. What if he hadn't been there? What if he'd been wrong? Or less honest? The United States had just discovered that its entire financial system rested on the judgment, health, and goodwill of one unelected 70-year-old man. Senator Nelson Aldrich says it plainly: something has to change. The response unfolds over 6 years. A National Monetary Commission, a secretive drafting retreat on Jekyll Island, Georgia, bankers traveling under first names only aboard a private rail car, and finally, in December 1913, the Federal Reserve Act. America builds an institutional Morgan, a permanent lender of last resort, so that the next panic would be met by a system instead of a seance in a library. Morgan himself never sees it. He dies in Rome in the spring of 1913, months before the act passes. The Panic of 1907 was his final performance, and the argument for making sure no one would ever have to perform it again, and the 2 men who lit the fuse. Heinze dies at 44, broke and litigated half to death. Morse goes to prison for bank fraud, wins release by faking a fatal illness, drinking soap suds before his medical exams, by the famous account, and returns to shipping fraud during the World War. Some men are machines with only one setting. Why does an honest panic belong in a series about fraud? Because 1907 is the negative image of every scheme we've covered. Ponzi, Howe, Miller. They manufactured confidence that wasn't earned. A panic is the opposite monster, earned confidence, evaporating all at once. Same lesson from both directions. The entire machine, then and now, runs on belief. And a century later, in 2008, when the shadow banks of a new era froze exactly as the trusts froze in 1907, the sequel would need more than one library. The playbook reversed. A panic obeys the same rules as a fraud, running backward. Rule 1. Confidence is the only collateral. Every bank, honest or not, is a promise-wearing marble. Rule 2. Doubt travels on the same rails as greed, and it travels faster. Rule 3. When the system fails, the system becomes whoever shows up holding a key. The paper empire ledger rests this week, no thief to charge. But mark the number it protects. In 3 October weeks, honest panic destroyed more wealth than every conman in this series combined, because money was never paper. It's belief, wearing paper's clothes. Next time on Paper Empire, the man who was in the 1907 crash as a boy trader and learned its lesson too well, Jesse Livermore, the boy plunger, who shorted the 1929 crash and made the equivalent of $1 billion in a week, and then lost it, as he lost every fortune he ever made. The greatest trader who ever lived, and the emptiest. Subscribe.